Okay, so for a session on corporate governance, it seemed appropriate to begin with a definition of corporate governance. Investopedia seemed to do not bad here. Corporate governance is the structure of rules, practices, and processes used to direct and manage a company. A company's board of directors is the primary force influencing corporate governance. So that's one definition. It's not bad. You could come up with others. There are many aspects related to corporate governance, as this word cloud highlights. Many facets, and I'm sure many people here with us today, as well as the profession as a whole, have done research on different dimensions that are highlighted here. That being said, for the purposes of a 1-hour talk, I obviously can't get to all of these, so I'm going to focus on a relatively small number, which relate to my recent research. I've always found Gombrowiczian metrics, characterization of governance, to be particularly helpful. Think of governance as the balance of power between management and shareholders. Is it better for management to have more control, akin to a dictatorship? Or is it better for shareholders to have more control along the lines of a democracy? How have these changed over time? Are firms becoming more democracy-like? Or are they becoming more dictatorship-like? And why? What factors potentially explain observed trends in governance? Is it variation in the optimal governance for different types of firms at different points in time? Is it variation in shareholder attention that pushes firms in different directions at different points in time? Or is it variation in who has power across different types of firms? And I'm going to spend some time talking about the ways in which my research shed light on each of these different aspects. Let's start here. There are many features that are part of whether a firm is more democracy-like or more dictatorship-like. I'm going to focus on just a few. Classified boards, also called staggered boards, is one that's gotten a lot of attention in the literature, as well as among practitioners. Under a classified board, each director serves a 3-year term, and 1/3 of directors are up for vote each year. This means that it requires at least 2 years to replace the majority of a board. That's going to make it more difficult for activists to affect change within a firm. This is effectively giving management more control, and as such, it's more along the lines of a dictatorship. The alternative would be an annual board in which all directors are up for vote every year. Second is a dual class share structure. Under dual class, 2 or more classes of shares exist, typically an A class and a B class, though sometimes a C class as well. One class, typically the B class, frequently has superior voting rights. Again, we're consolidating power within a fewer number of people, and as such, dual class is more along the lines of a dictatorship. The alternative would be a single class share structure where each share has equal cash flow and voting rights. And finally, the third is where the CEO also serves as chairman of the board, which is yet another way to consolidate more power within a fewer number of people, and as such is more akin to a dictatorship. Thus, each of these structures gives more power to insiders. It's like a dictatorship. They can facilitate agency costs, lessen monitoring, and facilitate private benefits of control. But importantly, these dictatorship structures also have potential advantages. They can lessen pressure on management for short-term results would be one possible advantage, and that's something I'm going to be talking about more in a bit. Okay, so let's look now at time trends. How are firms evolving over time in these democracy-type features versus dictatorship-type features? Bebchek, Cohen, and Wang conclude that the market has learned to differentiate between good and poor governance. If firms are pressured to increasingly adopt good governance structures, it should be informative to look at changes in governance over time. Start with classified boards. The percent of S&P firms with classified boards each year from 1990 to 2018 has exhibited a sharp decline, from 60% throughout the 90s and early 2000s to less than 30% today. On average, clearly firms are becoming more democracy-like along this dimension. What about the percent of S&P 1500 firms with dual class share structures? Again, firms are becoming more democracy-like. After somewhat of a rise during the 90s, we've seen a decline since then, and only about 6% of S&P 1500 firms have dual class share structures today. And finally, CEO chair duality, where the CEO is also serving as chairman of the board, again suggests that firms are becoming more democracy-like. It's almost a linear trend, right? It's declined by half. 70% of firms had CEOs serving as chairman of the board in 96, compared to only 35% today. So these trends are huge, right? They're very, very strong in the data. But importantly, these aggregate trends hide a lot of heterogeneity. Classified boards remain much more common in smaller firms. So here in this bar chart, I've put firms into quintiles based on their market capitalization each year. And what do we see? We see that among the smallest 3 quintiles, 50 to 55% of firms have classified boards, compared to only 40% of firms in the largest quintile. So along this dimension, smaller firms are more dictatorship-like. What about the CEO serving as chairman of the board? Well, along this dimension, it's larger firms that are more dictatorship-like. We've got almost 70% of the largest firms where the CEO is also chairman of the board, compared to less than 50% among the small firms. So again, very strong patterns among firms of different sizes. Why? Why would these governance structures differ so much across firms? Let's think more about firm size. Maybe it's that smaller firms receive less shareholder attention. We know that smaller firms on average would tend to represent smaller portions of investors' portfolios, so it would be rational for investors to devote less attention to these firms. That could conceivably cause smaller firms to face less pressure to adopt value maximizing governance. Firm age is another dimension, or number of years as a public firm. Firms at earlier stages of their life cycle tend to have higher information asymmetry, higher growth, and to derive a greater percent of value from long-term projects. Together, what does this mean? It means that it's harder for management of these firms to convey true value to shareholders. It means that the stock price is more likely to deviate from true value within these firms. That can mean that price drops will lead to pressure from activists, pressures to focus on the now, on the short term. But importantly, because these firms derive so much of their value from long-term projects, pressure to focus on the short term can destroy long-term value. That combination of factors means that there might be advantages of dictator-type governance structures where management has more control. Does that mean that younger firms have different optimal governance structures? So if we go back to the trends I was showing you before, starting with where the patterns in CEO serving as chairman of the board, something that's more common in larger firms, does that reflect the fact that CEO chair duality structures are more valuable for larger firms? Or does it reflect the fact that the CEO has more power in larger firms to structure things as he or she wishes? It could be either. What about classified boards, which are more common in smaller firms? Are classified boards more valuable for smaller firms? Or are shareholders less pressured to adopt optimal governance within these cases because investors are paying less attention in these firms? Again, it could be either. Looking at the trends in classified boards, again by firm size, what do we see? So as before, I've put firms into quintiles by market capitalization each year, and then I followed each quintile over time. What do we see? We see that the largest firms, that's the sort of turquoise line here, have had a very sharp trend in declassification to the extent that only about 10% of those largest firms have classified boards in recent years. In comparison, the smaller firms have a much less steep trend. Why is this? Is it a value type story, or is it an investor attention type story? What if we instead classify firms by firm age instead of by firm size? So again, I'm showing you the percent of firms with classified boards each year from the early 90s through just a couple years ago. This dotted line is effectively what I showed you before. So this is the percent of S&P 1500 firms that have a classified board. But here I've further restricted it to firms that are at least 5 years old. I'm going to compare that to the percent of IPO firms with a classified board. What percent of firms each year are going public with a classified board? We see that the trend goes the exact opposite direction. That's really striking. Dual class, I'm going to see the same thing. The mature firms, percent with dual class has decreased, while young firms has gone the exact opposite direction, to the extent that in 2017, over 25% of IPO firms, these firms are going public with a dual class share structure. Okay, so all of these factors, we have strong trends in governance. We have a lot of heterogeneity across different firm types. I've spent a lot of time in recent years thinking about why. And it's tricky, right? Because there are a lot of different factors. So I'm not going to claim to answer each of these questions, but I'm hopefully going to shed light on the extent to which each potentially plays at least somewhat of a role. I'll look at variation in optimal governance, shareholder attention, and who has power. So differences in shareholder attention to different types of firms is something that I've examined in papers with Peter Ilyev and John Kaladimos. Are there reasons that shareholders would devote more attention to larger firms and thus pressure more actively for change? Differences in optimal governance across different types of firms. Are there reasons that young firms would benefit more from classified boards and or dual class compared to more mature firms? This is something I've looked at in a paper with Laura Field, and we also have papers by Johnson, Karpoff, and Yee, Kim and McKaylee, Kramer, Slaughter-Balk, and Pajust, Ewens and Malenko, and more. So I apologize throughout this talk. I should have said this earlier. If I'm not citing your paper that's related to this, I've tried to highlight just a few. And finally, differences in who has voting power across different types of firms. Are there reasons that the CEO would have more power to choose a structure that protected private benefits of control with certain firms? Let me start here by talking about some of my research with Peter Ilyev and John Kaladimos. So one way to evaluate investor attention, arguably a very simple way, would be just to look at the percent of firm years with shareholder proposals. Again, I've put firms into quintiles based on market capitalization. And what do we see? We see that the smallest firms, the firms in the smallest quintile, less than 1% of those firms receive a shareholder proposal on average, compared to 8% of the largest firms. That is, large firms are 8 times more likely to receive a shareholder proposal. So unless it's the case that small firms are just better governed than larger firms, which seems sort of unlikely, this suggests that larger firms are simply getting more attention and more monitoring by investors. Now, shareholder proposals, though, that's a pretty narrow way to evaluate investor attention on governance-related things. It would be nice if we could have something a little bit broader. So what do we know about governance? We know that institutional shareholders have a fiduciary duty to vote their shares in portfolio firms every year. That suggests a duty for these investors to monitor each of these firms each year. They should vote for directors who contribute positively to firm value and against directors who do not. Importantly, there are multiple ways to satisfy this voting requirement. Option number 1 is the investor devotes resources to assessing items up for vote in each firm and the ways in which those issues would affect firm value. Now, that's going to take a lot of time, resources, labor, etc. The other, less costly approach would just be to indiscriminately follow the recommendation of one of the proxy advisory service companies. ISS is the largest of these companies. Glass Lewis is also a large presence in this area. I think we can all agree that option number one is more in the spirit of true monitoring by entities with skin in the game. But again, it's costly. So to the extent that in some cases, at least, investors follow option two instead, what does that mean? It means that shareholders are paying less attention to certain types of firms. Does that cause these firms to sort of get away with poor governance? This is something that John, Peter, and I are trying to look at. How do we do this? We take advantage of very detailed data to evaluate the extent of investors' attention to firms' corporate governance. Specifically, we're going to look at whether each mutual fund family views each firm's proxy statements in the period leading up to their annual meeting, i.e. in the days leading up to the shareholder vote. This is a really unique way to identify investor attention related to governance per se. So while the literature has used other measures of attention, things like Google search or Bloomberg search, those are much more general measures that might capture some governance, but likely capture a lot of other things. Our measure, which is looking at views of proxy statements, is very narrowly focused on governance. So for example, we're going to be able to observe, did the Vanguard mutual fund family view Wells Fargo's proxy statement in the period leading up to Wells Fargo's 2010 annual meeting? So let me explain how we do this. So for each mutual fund family, we're going to obtain their IP addresses, and we're going to do that using a digital elements lookup table, and I'll show you a picture of that in just a minute. From Edgar, we're going to get company filings between 2011 and 2017. And we're going to observe from Edgar, so Edgar's all publicly available information, we're going to observe information on the views of these filings, where each view is listed by its IP address. We're then going to match the Edgar filing views with the mutual fund IPs to determine which mutual fund families accessed which firms. And importantly, we'll be able to identify the specific filings that they accessed, as well as the specific dates and times that they access these filings. So again, let me show you a picture. Let's look at the first row here. So this is straight from the Edgar log data. Again, all publicly available information. So we have, as you can see in column A, a partially masked IP address. So a full IP address has 4 blocks. And what you see here is that the first 3 are available, the 4th is hidden. So what do we know from this line? We know that IP 192, 175, 173, IDH mask the filing, or access, the filing of this CIK 72971, which happens to be Wells Fargo, at 3:45 p.m. on January 31st. But given that this IP address is partially masked, how are we going to determine which mutual fund family this actually is? So this is just, again, I've copied over that same screen, the Edgar log data. Now let me show you what this digital elements lookup table looks like. So what we see from here is, in this box I've highlighted, the Vanguard group owns 100% of this block 192, 175, 173. In other words, it doesn't matter what 3 numbers this IDH stands for, because we know for sure from this lookup table that Vanguard owns 100% of those first 3 blocks. In other words, every 4th block out there. So I know for sure that it was Vanguard that accessed this Wells Fargo filing at 3:45 p.m. on January 31st. Okay, so what do the data look like when we put them together? So here I'm showing you views by the Vanguard Mutual Fund family and also the Fidelity Mutual Fund family. These are in event time across all holdings of these mutual fund families. So time 0 is the time of the annual meeting. That's when these mutual fund families have to vote their shares in each of the portfolio firms. And what you see is a sharp ramp up in the time leading up to the annual meeting in views by these mutual fund families. So again, this is the number each day, the number of proxy filings that are viewed by each of these mutual fund families. And consistent with expectations, after time zero, after the annual meeting, those views drop way off. So what's the conclusion from this very simple descriptive? It's that mutual fund families, at least these big ones, are doing in-depth governance research on their portfolio firms. But let's get to the question of interest. Do these mutual fund families monitor all portfolio firms equally? So I'm going to show you a few different graphs. In this one, we've put firms into quintiles by the rank in the investor's portfolio. So quintile 5 represents the firms that represent the largest percent of each mutual fund family's portfolio, and quintile 1, the smallest. And what do we observe? We observe that firms with lower weight in the portfolio receive less attention and less monitoring. This isn't particularly surprising from the investor's point of view. It's very consistent with investors' incentives. To the extent that in-depth research requires time and resources, you should devote those time and resources to cases where the benefits are likely to be the greatest. And on average, that should be among firms that represent the largest portion of your portfolio. But from the firm's point of view, it does mean that some firms are receiving less attention than others. And we can think about what the ramifications of that might be. This is a similar bar chart, but here we've put firms into quintiles based on the investment as a percent of total firm equity. So in other words, what portion of the firm does the mutual fund family own? And again, we see the same general pattern. If the mutual fund family owns a lower percent of the firm, they're engaged in less attention and less monitoring. They view, on average, a lower number of proxy filings in the days leading up to the firm's annual meeting. And finally, here we put firms into quintiles based on market capitalization. So quintile 5, these are the largest firms, and quintile 1 are the smallest firms. And here, this is particularly striking, right? The smaller firms receive substantially less attention. In fact, the strongest takeaway from this is that it's the largest firms, the firms in quintile 5, that are really receiving a disproportionate amount of attention, about 4 times as much as the smallest firms. You can certainly imagine that this would influence those small versus large firms. Okay, so those are all kind of firm characteristics, right? Size, performance is another relevant one. I didn't show that, but that also matters. Here I'm going to show you something that is fairly independent from these types of characteristics. We're going to look at how does investor attention vary as a function of the timing of the firm's annual meeting. What's the rationale here? We know, again, as we've said, that every institutional investor they have a fiduciary duty to vote on agenda items in each firm's annual meeting. It's also the case that about 3/4 of firms have a fiscal year end in December. And those firms all have their annual meetings in what's commonly referred to as the busy spring proxy season. And if you talk to anybody that works in this area, they will sort of tell you all kinds of crazy stories about effectively how insane this time of year is. Okay, it's just incredibly busy, rushed, et cetera, et cetera. In short, there's serious time constraints during these time of year. And you can imagine that these time constraints would cause these firms to receive less attention than they would if they had their meetings in another time of year. And that is exactly what we observe. So firms that have their annual meetings during this busy spring proxy season, on average, investors view significantly fewer filings of these firms compared to firms that have their meetings during other points in the year. We're going to actually rely on this to identify and assess the causal effects of investor attention. We're going to use this busy timing of the annual meeting as an instrument, which I'll explain a little bit more in a minute. Okay, before going on to that though, let me just show you a summary measure of how much investor attention varies across firms. And again, when I say investor attention, remember, we're really focused on governance attention, views of proxy statements. So the gray line shows this hypothetical distribution. So if every investor viewed each firm in its portfolio equally, okay, irrespective of any firm characteristics, if it viewed, if it had 100 firms in its portfolio, if it viewed each one of these firms an equal amount of time, that would be a hypothetical distribution, and that's what we observe with the gray line. In contrast, the red line shows the actual attention. So this shows for each firm, each publicly traded firm, how many times are their proxy statements actually viewed. And what we see is that the actual viewings are much more skewed than the hypothetical. Under the hypothetical distribution, about 15% of firms would have their proxy statement viewed either 0 or 1 time. And about 1% of firms would receive 10 or more views. In contrast, under the actual distribution, almost a third of firms get 0 or 1 view, and 5% of firms get 10 or more viewed. In other words, under the actual distribution, we have far more firms that are relatively ignored, and then also more firms that receive the lion's share of attention. It's a much more skewed distribution. So again, to get back to sort of the big question of interest, this skewness in attention certainly suggests that the underlying firms might be affected in various ways. Okay, so where are we? We know that investor attention varies substantially across firms. We know that attention varies both as a function of firm characteristics, size, performance, items on the agenda, this kind of thing, as well as the timing of the firm meeting, which is exogenous to these other factors. With this information, we are going to examine a few things. First, we're going to look at how investor attention affects investor monitoring. How does it affect their voting? How does it affect their exit, right? We have a large body of literature suggesting that exit is also a form of governance. And then we're going to look at how investor attention affects the underlying firms, different measures related to agency costs. Okay, so let's start with investor attention and the ways it affects monitoring. Looking first at voting. So what do we find here? We find that investors who devote more attention to the firm are significantly more likely to first independently vote rather than just following ISS's recommendations. They're more likely to vote against management, sort of a discipline type phenomenon. Both of these are consistent with more intense monitoring. So not only do these investors pay more attention to certain firms, it's the case that when they pay more attention, they also sort of push that further in terms of direct monitoring. What about the exit channel? Investors who devote more attention to the firm, we find, are significantly more likely to decrease the weight of the firm in their portfolio and also to completely divest their holdings in the firm. Again, consistent with more intense monitoring. Moreover, going back to that busy instrument that I talked about before, these relations are all causal. We use the timing of the firm meeting, i.e. whether it falls into the busy spring proxy season, as an instrument, and we can show using that as an instrument that this greater attention actually causes these different measures of more intense monitoring. What about at the firm level? So first, let's sort of think about the economics of it. How would we expect attention to affect underlying firms? To the extent that investors who pay more attention also engage in more monitoring, we would expect that that would have a causal effect on agency costs. We would expect that greater attention and greater monitoring would lead to lower agency costs. Now, there's lots of different measures of agency out there, but empire building is certainly one that has received a lot of attention in the literature. So we're going to focus on this. We're going to look at different measures of empire building. First, we're going to look at the investment side of things. And then second, we'll look at the payout policy side of things. To the extent that that greater investor attention causes less empire building, we would expect lower investments and greater payouts. This is exactly what we find. We find that firms who receive more investor attention engage in significantly fewer mergers, both number and value, as well as significantly lower capital expenditures. Along the lines of payout policy, we find that firms who receive more investor attention pay significantly higher dividends and have significantly greater repurchases. And again, these relations are causal using that same busy spring meeting as an instrument. Okay, so where are we? We're trying to think about what causes stark differences in governance across firms, and this body of papers on shareholder attention provides at least some indication that this dimension, this channel, does play a role. What about differences in optimal governance across firms? Is that also playing a role? Are there reasons that young firms, for example, would benefit more from classified boards and or dual class compared to more mature firms? And this is something we have sort of a set of papers related to this. I'm going to talk a little bit about my paper with Laura Field that's focusing on this issue. Okay, so these are the graphs that I showed you earlier, showing that while mature firms' frequency of classified boards and dual class is decreasing, the rate of both these structures within new IPO firms is actually going the exact opposite direction. It is increasing. Okay, so why? So as I sort of touched on briefly before, there's literature suggesting that classified boards and dual class have benefits as well as costs. In particular, these structures, they protect management from outside influence, from pressure from external shareholders. This can be costly because it entails less monitoring, but it also can be beneficial to the extent that it mitigates these myopic tendencies. It mitigates pressure for management to focus on short-term fluctuations in the stock price. It mitigates pressure on management to take projects that contribute to higher short-term stock prices at the expense of long-term value creation. And we know from surveys by John Graham and co-authors that these are real issues that firms struggle with. These benefits should be greatest among firms with highest information asymmetry. Why? Because those are the firms in which management finds it most difficult to credibly convey true value to outside constituents. So these young companies where we saw this increase in classified boards and dual class, they tend to have high information asymmetry, particularly in more recent periods, which I'll show you. They tend to be more R&D intensive, suggesting importance of focusing on the long term, suggesting that an over focus on short term would be costly. So the question that Laura and I are trying to get at is, has the increased attention to corporate governance over time pushed mature firms to declassify boards and move away from dual class in ways that are optimal for them, and newly public firms to classify their boards and have dual class in ways that are optimal for them? Okay, but the challenge here is, how do you assess this? How do we assess whether firms' governance is optimal? One way would be to try to compare firm value across different types of firms. The challenge, as I'm sure everybody here can appreciate, is that there are serious endogeneity problems in taking this approach. We would either require firms to be randomly assigned certain governance structures, which obviously we don't have, or alternatively, we would require an instrument related to governance structure but not firm value, which again is pretty hard to find. So we're going to take a different approach. we're going to go back to shareholder voting. We're going to evaluate the opinions of entities with skin in the game, the shareholders. What are they saying through their votes about firms with these governance structures? We'll begin with a look at ISS recommendations. Why? We know a lot of funds follow ISS, so it seems like a reasonable starting point. We also know, though, that ISS tends to use one-size-fits-all strategies. That means if a governance structure is suboptimal for a typical, more mature firm, ISS might similarly deem it suboptimal for an IPO firm. So we're going to want to think about that. As a basis of comparison, in particular, given these one-size-fits-all concerns, we're going to look at the votes of the most engaged mutual funds. These are the funds with the strongest incentives to independently evaluate the issues up for vote. They devote attention to the firms rather than just following the ISS recommendations. And we'll use a proxy for that I'm not going to go into a lot of detail here, but it follows the measure used in Iliev and Lowry 2015. Okay, so what do we see? Again, let's start with ISS recommendations. First, these first two bars just compare the percent of directors that ISS recommends against in mature firms compared to IPO firms. And this is striking. When I first saw this, I was just completely sort of blindsided. In mature firms, ISS recommends on average about 6% of directors. In comparison, ISS recommends over 3 times as many directors in IPO firms, 20%. And I should say for IPO firms, technically what we're defining here is firms within the first 5 years that they are public. Okay, sort of this newly public recent IPO firms. Enormous difference. Okay, so let's look then at these IPO firms. Let's look within different categories of IPO firms to try to get a sense of what maybe is driving these against recommendations. And I'm going to split firms by various governance structures. First, I'm going to split firms by classified boards versus annual boards. And what do we see? We see that this tendency of ISS to recommend against a firm's directors is significantly higher in firms with classified boards compared to annual boards. Similarly, if we classify firms by dual class versus single class, we get the same pattern. Firms are much more, or investors are, ISS is much more likely to recommend against directors in dual class firms compared to single class. And finally, we take just sort of one summary measure. Is the firm a controlled company or a non-controlled company? And we see very dramatic differences to the extent that the percent of directors that ISS is recommending against in a non-controlled IPO firm, it's higher than a mature firm, but not that much. Okay, so again, ISS's against recommendations within recent IPO firms certainly appear to be related to the firm's governance choices. And these patterns, which I'm just highlighting through figures here, hold up very strongly in a series of regressions where we kind of throw in everything under the sun. The question, of course, now is why does ISS recommend against these firms? Is it because firms have suboptimal governance? Or is it because ISS is using one-size-fits-all strategies where these structures are bad for mature firms? And so ISS just sort of follows that through and says, well, it must be bad for everybody. So as a way to get this, let's look at the percent of directors that engaged mutual funds vote against. What do we see? Again, focusing within newly public firms. When we divide firms by whether they have a classified board or an annual board, remember, when we looked at ISS, we saw that ISS was significantly more likely to vote against directors of classified board firms. But the engaged mutual funds, the entities with skin in the game, no difference. They are equally likely to vote against directors with versus without a classified board. What about dual class versus single class? Now here we see a difference. Okay, so those engaged mutual funds, they do appear to think that dual class firms are worse than single class firms. But I want to push this one step further, because one thing that we observe with dual class firms is some have a very high wedge between the cash flow rights and the voting rights, whereas others have a very small wedge. So we split firms by the size of this wedge. We're going to put firms into a high, above median wedge versus low wedge, again, within the set of dual class firms. And when we do this, we see that much of this higher tendency of mutual funds to vote against dual class firm directors is concentrated within those dual class firms that have a high wedge. So again, what's the takeaway here? We find that engaged funds are substantially less likely compared to ISS to oppose classified boards and dual class with a low wedge. In fact, when we look across many of these categories, classified boards, annual boards, single class, or dual class with low wedge, we find no significant differences. And again, that's across the regressions that I'm not showing here, but that which control for all the other characteristics. It's really dual class with a high wedge that mutual funds, these engaged firm owners with skin in the game, really appear to fear is a problematic governance mechanism. Okay, so entities with skin in the game, they appear to largely conclude that many of these controversial governance structures are optimal for firms at early points in their life cycle. Classified boards, dual class with a low wedge. A notable exception, as I just showed you though, is the dual class with a high wedge between voting rights and cash flows. These are the cases where insiders have really consolidated a lot of the control. Engaged funds are significantly more likely than ISS to vote against these firms. So let's so these are sort of all these cross-sectional patterns. I now want to take those patterns and bring them back to the time series. So from the voting analyses, we know that investors are viewing classified boards and dual class with low wedges as optimal for newly public firms. But how does this explain the time trends in these structures that I showed you before? Why is it that classified boards and dual class are becoming more common among IPO firms? Is it because the type of firm going public has changed over time? We know that these governance structures are more beneficial among firms with higher information asymmetry and firms that derive a larger percent of their value from long-run projects. So if this time trend is explained by these optimal governance stories that the data seem to support, it has this further prediction that the type of firm going public must have changed over time, such that firms in more recent years are characterized by higher information asymmetry and more long-run type projects. This is exactly what we find. So if we look at the percent of IPOs in different time periods with positive R&D, we get almost a linear time trend. I can also look among firms with R&D, what's median R&D, and I'm going to get a similar picture there. If I graph the median profitability, the median EBITDA as a fraction of assets, firms are also becoming less profitable. So in short, yes, the type of firm has changed in terms of the type of IPO firm over time. This is very consistent with this optimal governance story. The type of firm going public has changed in ways that make classified boards and dual class with low wedges more optimal for more recent IPOs. This is why they have them. And the engaged mutual funds, they vote in a way that is consistent with these structures being value maximizing for these firms. Okay, so factor number 2, differences in optimal governance. Again, it does seem to play a role. Let's go now to factor number 3, differences in who has power. Are there sort of reasons that the CEO would have more power within certain cases to choose a structure that protected private benefits of control within certain firms? So we've got a few recent examples that are pretty striking here, right? Palantir, recent IPO, Class A shareholders got 3% of the vote. WeWork, which we of course know was failed, but nonetheless, when they first filed, there was 3 classes of stock. Class A only got 1 vote per share. Classes B and C, that's what Adam Newman, the founder, held, 20 votes per share. Snap IPO, the new investors got 0 voting rights. What is going on with these firms, right? I mean, clearly these founders do not want to give up voting control. So these are some pretty salient examples. As academics, one of the advantages we have, though, compared to the media, is a lot of data. I want to look at how common are these? Are these very pervasive, or are they more exceptions? And as a way to get at that, we're going to look at the distribution of voting power within dual class IPOs. So what do? We look across every dual class IPO in our sample for which we can get data, and we tabulate the percent of all voting power that's held by CEOs compared to everybody else. And what we found, at least to us, was very surprising. We find that in 59% of dual class IPOs, this is just a histogram here, it's showing the percent of IPOs that fall within these different buckets of CEO voting percentage. And this first bucket, 0 to 10%, that's showing us that 59% of dual class IPOs, the CEOs have less than 10% of the voting power. And in 82%, the CEOs have less than 50%. I can extend this to all officers and directors. And even here, in almost a third of dual class IPOs, all officers and directors have less than 10% of the voting power. And in about half of cases, they have less than 50%. So what's the takeaway from these graphs? My takeaway is that these type examples are more exceptions. But let's push it one step further. Let me concentrate on perhaps the most egregious set of dual class IPOs, those that are founder firms. What do things look like here? The percent of voting power held by CEOs versus all officers and directors. We find that even among founder IPOs, in almost 3/4 of cases, the CEO lacks majority control. And in about a third of cases, all officers and directors lack majority control. So what's our takeaway from all this? I would say there are some IPOs with a dual class structure and high wedges between voting and cash flow rights, in which insiders have substantial control without question. And multiple analyses suggest that these structures do not represent optimal governance. The engaged mutual funds are significantly more likely to vote against the directors of these firms. These IPOs receive a lot of attention in the media, but they appear to be a relatively small portion of all IPOs. And related papers conclude that dictator-type governance structures are similar to us, perhaps optimal at the time of the IPO, when insiders' vision is especially important. This follow-on set of papers suggests that they may be more likely value destroying in later years when monitoring becomes more important. So this is very much a complementary sort of side of research that I think together tells a very compelling story. So again, in sum, I think when we look across these different types of governance, it's really informative to think about how governance varies across different types of firms. I've suggested 3 different factors here, and at least in my research, they all appear to play a role. But I think there's a lot more that can be done. I think there's a lot more that we can learn here. There is this substantial heterogeneity. What are the drivers of this heterogeneity? I think each plays some roles. Some of these differences are efficient. To the extent firms have different optimal governance structures, we certainly don't want to push all firms in a single direction, and that's incredibly important to recognize. But there are also differences that are less likely to be efficient. And I think it's informative from a policy point of view to think about what we can potentially learn here, and are there any ways to improve things. I think there's a lot more that can be done in this area, thinking about how these differences affect other firm dynamics, firm policies, other governance features, and something that I've started thinking more about, environmental and social profiles of firms. And let me just end here with one sort of more recent working paper where I've been thinking about these environmental and social issues. This is a paper co-authored with Ellen He and Biga Kahneman, where we look at shareholder proposals related to environmental and social issues. About a quarter of all shareholder proposals relate to these issues, and support for these proposals is steadily increasing over time, suggesting that shareholder proposals are pushing firms toward a more environmental and social friendly agenda. But let's go back to what I showed you before. Remember, only 1% of firms in the smallest quintile tend to receive shareholder proposals. To the extent that small firms are less likely to receive investor attention, shareholder proposals, attention more generally, what are the ramifications for this from an environmental and social standpoint? Again, interesting questions in my opinion, which we really don't know the answer at this point. So in sum, that's where I'm going to leave off today. I hope you found it interesting. I'll stay online for a few minutes. If anybody has any questions, please go ahead and put them in the chat room. I tried to answer some I saw as I went along, but if anybody has any others, like I say, I'll stay on for any questions that come up. Okay, so Jeff Coles asked, to isolate inefficiencies, do you need a model for what is optimal and for how it varies by industry, other characteristics, so as to then measure departures from that optimal structure? This is a great question. I unfortunately know nothing about writing models, so I am not the person to do this, but I do think that the literature can benefit a lot from this. I think that we have some broad economic constructs for how optimal governance differs across different types of firms. Things related to the information asymmetry, to the portion of firm value that derives from long-run projects. But I think there's a lot more, thinking about the ways that it varies across industry, for example, across type of projects, perhaps by the tangibility of assets. Again, I'm sort of just thinking off the top of my head, but I would agree with the general question. I think that for a theorist, there are also a lot of opportunities here to put more structure on this. Thanks, Jeff. A few people have, oh, sorry, one more question. Any idea how, so somebody asked about executive compensation. I actually almost listed this on this sort of last set of bullet points. I don't know personally how it relates to executive compensation. There has been some work in that area. I'm not going to, I don't know it as well as I should, so I don't want to miscite, but I do think there are opportunities for this. So thinking about what is the optimal compensation as a function of these different things, I do think is something that we could learn a lot about. A few people have asked whether I will post my slides. I will post them on my personal website. Just Google me, it will be there. I would assume the FMA will probably make them available as well.